Jake buys a rental property, and Marcus buys a number on a screen. On day one, Jake looks richer, while Marcus looks like he forgot to try. And that's exactly why most people get this wrong, because one of them is measuring visibility and the other is measuring reality, but neither of them is measuring everything. So let's fix that. Same city, same age, same salary of $55,000 a year, and the same starting point with $50,000 in savings. The only difference is what they do next. Jake turns his $50,000 into a 20% down payment on a $250,000 rental, takes a 30-year mortgage at 7% interest, and pays about $330 a month. He finds a tenant willing to pay $1,800, and on paper that's $470 a month in profit. He doesn't even finish the calculation, he just smiles because it feels like he cracked the system. Marcus, on the other hand, does something that feels almost insulting in comparison. He takes the same $50,000, puts it into a total market index fund, sets up a $300 monthly contribution, and then does absolutely nothing. No tenants, no leverage, no story, just silence. And that silence is exactly why nobody takes him seriously. Jake has keys, Marcus has a login. Jake has conversations, Marcus has statements. Jake feels like he's winning, and in the short term, it actually looks like he is. For the first few years, Jake is living what people imagine real estate to be. Rent hits every month, he drives past the house and thinks, I own that. Tax deductions start shaving money off his income, and the property value ticks up slowly. Everything feels real, tangible, and smart. Marcus logs in once every few months, watches $50,000 become $55,000, then $61,000, up, down, and up again. Nothing dramatic, nothing exciting. No one asks him about it, and no one is impressed. And that's the trap. Because the early years reward visibility, not efficiency. By year 3, Jake has collected about $64,800 in rent, and his mortgage payments total around $47,880, so on the surface, he's up $16,920. That's the number people love, the number you hear at barbecues, but that number is incomplete. Property taxes take about $3,000 a year, insurance adds another $1,500, and then reality starts showing up uninvited. A water heater breaks for $1,200, a roof leak costs $2,800, 1 month of vacancy removes $1,800 in rent, and cleaning and relisting adds another $600. Then there's time, late night calls, weekend showings, and midday repair coordination. He didn't hire a manager, so he became one. After everything, that $16,920 shrinks down to maybe $2,000 to $4,000 over 3 years, and that still doesn't include the value of his time. Marcus invested $50,000 upfront plus $10,800 in contributions, and at around a 10% return, he's sitting near $76,000 with no calls, no repairs, and no stress spikes, just quiet growth. Jake still has one powerful advantage: leverage. His $250,000 property is now worth around $270,000 to $280,000, and his equity sits roughly between $55,000 and $65,000. That growth didn't come from his money alone, it came from the bank's money, and that's the part stock investors can't easily replicate. But leverage cuts both ways, because the rent check everyone talks about is not the money you keep. Vacancy eats about 1 month a year on average. Maintenance quietly drains 1 to 2% of property value annually, and big expenses don't ask for permission. Roofs fail, vac systems die, and water heaters don't negotiate. These aren't surprises, they're scheduled problems, and if you're not saving for them, you're not investing. You're gambling. Then there's the risk no one likes to say out loud: bad tenants. One tenant who stops paying can wipe out 6 months of income, plus legal costs and stress that doesn't show up on spreadsheets. None of that is in the $470 profit, but all of it is real. By year 5, Jake understands this better than anyone. He's replaced a roof for $8,500, handled plumbing issues, and dealt with vacancies. Rent has increased to $1,950, but so have taxes and insurance, and his real return lands around 3 to 5% after everything. Not terrible, but not the 15% he once believed. Marcus is still doing nothing, and that's exactly why things start accelerating. By year 7, his portfolio sits somewhere between $135,000 and $150,000 with no strategy changes and no extra effort, just time doing what effort can't. Because compounding is invisible until it isn't. Jake's growth is linear and interrupted, while Marcus's growth is exponential and uninterrupted, and that difference doesn't feel big early on, but it becomes everything later. By year 10, Jake's property is worth around $335,000 to $350,000. His mortgage balance is about $166,000, and his equity lands near $170,000 to $184,000. Marcus's portfolio sits around $165,000 to $180,000, so they're almost tied, but look closer. Jake took on 6 figures of debt, managed a physical asset, and spent hundreds of hours while Marcus clicked a few buttons and waited. Same destination, completely different journey. By year 20, Jake's property reaches around $450,000 to $500,000, his mortgage is nearly gone, and his equity is close to the full value. He's also collected rent for 2 decades, but after all expenses, repairs, and major upgrades, his total profit from cash flow might land between $40,000 and $80,000. Marcus's portfolio grows to roughly $420,000 to $460,000 with total contributions of about $122,000, and everything else is pure compounding. No debt, no tenants, and no emergencies at 2 a.m. The end result is that they're in the same range, roughly $400,000 to $500,000, but the cost to get there wasn't the same. Jake traded time, attention, and stress, while Marcus traded patience. And here's where the math shifts dramatically. If Marcus simply increases his monthly contribution from $300 to $500, his portfolio jumps to around $550,000 to $600,000. Because in the market, more input doesn't just add, it multiplies. In real estate, more input usually means another property, another loan, and another workload. To be fair, stocks aren't perfect. Volatility is brutal, markets can drop 30 to 40% fast, and watching your portfolio fall like that is emotional, not theoretical. Most people don't hold through that. They panic, sell, and lock in losses. Real estate doesn't show losses the same way. It feels stable even when it's not. There's also cash flow. Stocks don't send meaningful monthly income unless you've built a large base, while real estate can. Leverage is real estate's superpower. Controlling $250,000 with $50,000 is a force multiplier, and tax advantages like depreciation are real benefits. So no, real estate isn't bad, it's just incomplete when people explain it. Real estate wins when the rent-to-price ratio is strong, when you treat it like a business, when you use strategies like house hacking, and when you understand tools like 1031 exchanges. In those cases, it can outperform, but that's not the version most people buy into. They buy the simplified version, the highlight reel, the $470 profit, and ignore everything behind it. The same happens with stocks, where people sell the idea of just invest and relax, but ignore the discipline required to not panic. So Jake wasn't wrong, and Marcus wasn't wrong. They were both incomplete. Because the real mistake isn't choosing real estate or choosing stocks. The real mistake is choosing without running the full math, dollars, time, stress, and risk. All of it. Because the version that includes everything is the only version that matters. So next time someone tells you one always beats the other, don't argue, just ask one question. Did you include everything? Because if they didn't, their answer doesn't count.